Welcome to the Wealth Without Wall Street podcast, your guide to understanding how to get out of the Wall Street rat race and start your own mailbox money lifestyle. Now, don't let these handsome Southern draws fool you. These financial minds are teaching our country to enhance savings, increase cash flow, and create passive income, all without the help of Wall Street. Are you ready to break through? Now here are your hosts, Russ Morgan and Joey Murray.
Welcome into the Wealth Without Wall Street podcast. This is Russ Morgan with my co-host, the Italian Stallion, Joey Murray. What's up, Stallion?
Man, I'm still reeling from the sugar high.
The sugar high? You've been eating a bunch of candy from Halloween?
Dude, I ended up with so much candy as my commission. You know, dad commission? You know what I'm talking about.
I have to hold the bag for a couple trips around the.
Oh, dude, I'm sitting here pulling the younger two in the wheelbarrow thing. Whatever. What is that thing?
Yeah,
the wagon.
Like the red flyer.
Dude, I mean that thing is heavy. Okay.
Well, your kids are heavy, bro.
Then you add the candy on that. My commission was stout.
There you go. Well, I had a pretty neat experience that I think translates to today's podcast. My kids came home from a trunk or treat, sat down at the tables, divvied up all their candy, and then went to straight up trading. And it was just so fun to sit there and watch from 5 years old all the way up to the 13-year-old negotiating and how they would negotiate and the persuasion skills. Like they've been watching me. Some of them has really gotten, like my wife was looking at me, was like, yeah, that one's got all you and some more in there.
Well, it's a little unfair. The 13-year-old and you know, my oldest is 12. They have a severe advantage at this point, right?
You're not kidding me. I was sitting there watching her like trade like the Dots candy and those sorry like Jolly Ranchers that she knows her mom's not going to let her eat because she's a dentist, and like trading it for Snickers bars and Butterfingers.
Oh, top shelf
Reese's cups. I'm like, goodness, man, this is no good. Like, have you guys not seen? We've played Monopoly together. Figure out a way.
Yeah, so you obviously took the time to say, guys, this is how negotiation works. You use that as a teaching opportunity, right?
Well, just like our guest today talks about, education and instruction are different. I clearly did not give them enough instruction on how to negotiate because there were some winners and there were some losers in the game.
Clear losers.
Yeah, I mean, the kid walking around with the Laffy Taffy is not the winner in my house because ultimately mom's going to snatch that candy from him and he's not going to have anything. But today, we're going to get into how our guest, who's been leading the charge in the real estate community, is actually taking this nationwide, by the way.
Yes.
Is going to explain to us why investing in turnkey real estate today might not be such a good thing.
Man, you're not kidding. That was a big hit in the stomach whenever he told me that. But I love where he led it to, and he kind of shifts the tables on it. So you're not going to want to miss Brian Trippe. This interview, we need to get right into it. Have you ever had the thought, I really am not saving enough for the future? And at the same time, you're sitting down to write an enormous check to the IRS every single year for $100,000, $250,000, $500,000 in taxes? Guess what? We just found the money that you should be saving, and it's been under your nose the entire time. Go to freetaxwebinar.wealthwithoutwallstreet.com and learn how the wealthy are paying less in taxes. You can implement these strategies so that the next check you write will be to your financial future and not to the IRS. Welcome into the Wealth Without Wall Street podcast, and we are live with Brian Trippe, who just literally dropped an A-bomb on us, Russ.
An A-bomb.
The A-bomb. He said, don't buy turnkey real estate. What? Yeah. That's what our people have been talking about for weeks now, ever since we met with Spartan Invest, right? Turnkey real estate is a way to create passive income. So Brian's got some explaining to do.
Well, I love the fact that he's being a contrarian because at Wealth Without Wall Street, Brian, we tend to buck the system. I was looking over your book. I noticed that you had a paragraph, a section that says that you tend to get thrown out of real estate meetings. I can relate to that. I've been thrown out of a few financial meetings. So anyway, welcome to the show.
Wow, guys. Well, first of all, I want to thank you guys so much for the opportunity to be on your show. I love that you picked up my book for 3 minutes and picked out one line with no context whatsoever. So people now are like automatically judging me right off the bat. But no, I am glad to be here. I'm here to provide as much value to you and your audience as I can. I'm an open book when it comes to real estate. I've been investing in real estate for going on 7 years right here in the Birmingham, Alabama area. So I'm glad to be here and provide you guys with value.
Well, that's why we had you on the show, because you are an expert and you've taken a process to educate yourself on this whole thing, going from being a coach to now being 100% full-time in real estate and creating a massive empire, if you will. So tell us real briefly that kind of move from being a coach to now, and maybe a little bit about what REI Live is.
Sure. So you said briefly. That's about 6 years of my life there. A lot of stuff happened. So I am a former Division I college basketball coach. I coach here at UAB as basically a glorified GA for a couple of years, and then I was at Troy University for a year. Did some junior college work as well, and I've always had teaching. I was an adjunct English professor as well. I've always had teaching and coaching in me. And so I knew that once I got into real estate, my eventual end game was going to be to coach or teach in some respect. So you asked what REI Live is. Real Estate Investing Live is just a series of live events that are taking place all over the country. And I say that because that's where we will be. But right now we have 2 affiliates outside of Birmingham. We have Birmingham, obviously. We put on live events here in Birmingham when we try to educate. And I use that word loosely because I do believe that education is the number one reason people fail at real estate, because there's way too much education and there's not enough instruction. So we actually try to instruct people. And I think the difference is, hey, I can give you a bunch of theory, or I can give you the step-by-step how-to on how to actually get this done. And so I'm a big believer. Like I said, I'm a teacher. I'm a coach. I want to instruct someone, here's step 1, here's step 2 on how to be successful at what I've been able to do in real estate. So far, we've been doing that model for going on 2 years now. And we're going national. We're taking this thing national, and we're very excited about it. I have some partners along with me that are just some incredible rock star real estate investors all throughout the country that if you're in the real estate space and I drop these names, you'd be like, what? But yeah, it's pretty exciting.
So when you mention there's a difference from education versus instruction, I totally can see that, especially from a basketball standpoint, right? We could give Joey a book on how to dribble a basketball. But if you gave him a basketball, you would really see that he needs a lot of instruction. And I think the same thing's probably true. Don't look at me. I've seen you in the gym. Yeah, it's not close. You're terrible.
Come on. You hold it with 2 hands, and you go between these, and you shoot it up, right?
No. But when it comes to real estate, right, there's a lot of books, and I've read a few of those books, but it's different when you're actually out there buying property and you're seeing the transaction happening for the instruction. So go into that. Like what is that difference maker for you guys? How are you guys?
Right. So you're talking about the application, mm-hmm. which is great. Obviously to do it, you're going to learn and you're going to be able to have more success. I'm really talking about the difference between theory and like a step-by-step. So for instance, let's just use Rich Dad Poor Dad. I think if you're in real estate, most people have either heard of that book or read that book.
Oh, tons of our listeners. I mean, we all talk about Rich Dad Poor Dad.
So we talk about Rich Dad Poor Dad, and what does it say in that book? It says your house is not an asset, right? That's theory. That's just like your house is not an asset. There's no way for me to practically apply that theory, that principle, without some instruction. What do I do? Okay, so you told me my house is not an asset. So what do I do now? Like what? Just not treat it as an asset? Like, you know what I'm saying? That's the difference between education and instruction.
How does that truth impact me?
Or how to unpack that truth. How to actually okay, so if it's not an asset, so what do I need to do now? I need to either start renting. I need to just not put it on my balance sheet. I need to treat it. An asset is defined as something that is going to pay me, right? And if my house is not paying me, then it's not an asset. So let's try to devise a plan to where we can actually see our house as an asset.
So do you see that as one of the biggest problems facing real estate investors, is that they've got a bunch of theory, but they don't have really step-by-step instruction?
So let's break these camps into two different people then, because you've got actual people who are investing in real estate and are trying to educate themselves. And then you got a lot of quote unquote passive investors that are diversified and they're in real estate. So I feel like those are two different people. Do you want me to talk to both of those or just...
Well, I think we tie this back to your initial A-bomb question or point that you should not buy passive turnkey real estate right now.
Okay. So, you guys are kind of going all over the place, but I love it. I'm just going to talk and you interrupt me.
This is how we do it.
Hey, this is awesome. I love it. I'm just going to start talking. And if I've answered the question and they're great, and if not, just interrupt me.
Okay.
So
we're good at that too.
So there are two different camps, and I think it's important to distinguish because there are a lot of people out there who are either full-blown real estate investors. If according to the IRS, they are a real estate professional. And they get the tax advantages and they're actually doing this full time. It's their living. For people like that, they're actually in the business. They don't need the instruction. Like theory is great for them because they're going to go apply that theory in the way that they see fit. The person, which I think is probably closer to your audience, is someone who either holds real estate today and maybe doesn't know a ton about it. They're not a real estate professional. They're not an expert, but they know they need to be diversified. So they're holding some real estate. Let's talk about that person for a second. I think it's obviously very wise to read. I think it's very wise to watch YouTube videos. I think it's very wise to listen to podcasts like this one and other real estate podcasts to try to further your education. I'm not saying that education is a bad thing. I'm saying there's a big difference between education and actual instruction for people who want to actually go out and do this business. The person that may be your client or the person that may be your audience is someone that may not be a real estate expert, but they hold real estate or they want to hold real estate to diversify. So instruction is less important for that person. Education is probably more important for that person because they just want to know enough to where that, I know enough to where I know I need to be diversified. So to continue to jump to the next question, which is, what you called an A-bomb. I don't really think it's an A-bomb, but let's talk
My
about
feelings were hurt.
Let's talk about turnkey real estate for a
Okay.
second. And I know you've had some people on here in the past that have talked about how great turnkey real estate investing is. And the company that you have had on here talking about that is one of my sponsors at our group. So I'm very cognizant of what they do. And to be honest with you, they are the best ones at Spartan. If we're talking about Spartan Invest,
right.
They are the best at what they do here in Birmingham. Like if you were to pick any turnkey company, I've seen them all. I've kind of really gotten to know all of the turnkey companies here in town. They're the very best. And it's not even close. And what sets them apart is their management. And management, when it comes to any real estate, especially if you're, from afar, you're trying to invest from afar,
sure.
Management is the critical piece.
It's a game changer, no doubt.
So it's a difference between two companies that have the exact same product, exact same house, and they sell at the exact same price, but their management and their numbers, and it's just like, it's ridiculous.
Yeah.
How good they say their numbers are. And I don't know their business, but what they claim their numbers are, I've never heard of it in the turnkey space. So, and I've heard a lot of people talk about them from a turnkey provider from out of state that they go on and on about them. Here's the problem with turnkey real estate today. The biggest problem is prices are way out of control. Everything's overpriced. You're buying an asset that could be worth 25 or 30% less than it is today just in another year or two. I'm not here to speculate. I am a cash flow investor first. So if you are buying for cash flow, you're not buying for appreciation, right? Probably. So those numbers probably aren't going to matter anyway, but they do matter in this sense. Most people who go out and get a loan, which that's most people are going to get a loan on a turnkey property. They're going to leverage it,
yeah.
Did you know that any kind of commercial loan, like almost across the board, no matter what lender you use, they're all going to have a 5-year balloon? Almost. And so let's say you do get a 30-year fixed. Let's say you get a 30-year fix on a piece of a turnkey rental. In almost every mortgage, everyone I've seen, they all have a clause in there that says that they can come and take that property if they think it's at risk. If the bank thinks it's at risk, not because you missed a payment. if the bank thinks you're at risk. And do you think it's risky to buy a house, let's just say for $100,000, it rents for maybe $1,100, and now all of a sudden the bank went in, they want to do an independent appraisal, and now all of a sudden it appraises for $80,000 when we take a little dip in the market, and you're leveraged at 75%, and the numbers are too close for the bank, and they just they can say for whatever reason they want, they can come take that property. Mm. And I've seen it happen with my own eyes. I've seen that, and that's a lot of what happened in 2008, 2009. Banks just came and took properties, not because people were behind on payments, and that's only one small reason. That's one small reason.
Yes, I want to break that down. So yeah. I get the potential for risk in buying properties, and we've seen that too. Like we've had clients that are involved in some multifamily stuff, and the cap rates have just continued to drop and drop and drop. And they're in a position now where literally we're looking to sell the properties to be able to meet our expectations because they just can't rent. And it was really the properties were bought in the last couple of years, still inflated 2 years ago, and now we're 2 years further. So how does someone, if they're buying for cash flow and they're going to do it outside of turnkey, can they avoid that risk you're talking about?
Value add. That's if you're going to buy real estate today, this is my opinion. Let me say that. This is my opinion. There are a lot of people buying right now at 5 and 6 and 7 caps, and that's great. Have at it. Birmingham, I'm not buying in Birmingham personally for less than, for me, 20%. That's because I can get them off market. But if it's you and you're listening to this, you should not be buying property at less than a 12, 13, 14 cap here in Birmingham because of what you just got done saying. And we are at a spot in our market cycle. It's the longest bull run in history for real estate. And it probably is for the stock market too. I just don't pay as much attention to the stock market.
Neither do we.
Neither do you guys because this is without Wall Street, right? So I can't really speak to that. I can only speak to real estate. It's the longest bull run in history. Okay, we've never gone this long. And we're at 10 years now? We're in the 10th year now of this bull run. It's coming. And I literally just got back from a conference this past weekend where some of the smartest people in real estate are at this conference, and they're breaking down charts. And they all kind of talk about California, Nevada, Arizona, Colorado, and Florida.
I was going to say, don't forget Florida.
These are the states. These are the states you look at to see what is going to happen. Now, Birmingham, and I know this is more of a national show, but I can only really speak to Birmingham. Birmingham is not a volatile market, period. It's a cash flowing market. It's not an appreciating market. It's always going to cash flow. But in 2007, 2008, we did not see a huge drop off either. We saw a dip. We didn't see a huge drop off. But here's the thing about real estate. It's local. So you have to pay attention to the local aspect, but you have to pay attention to what's going on in these 5 states. These 5 states, it starts there and then it comes to the rest of the country.
Sure.
So what are you seeing in those 5 states right now?
Right. So I just got back from this conference. And this is what they're talking about. This is what we're seeing. We're seeing more sales, or seeing less sales, but we're seeing the average sales price continue to go up. And if you look back in 2007, 2006 and 2007, average sales price was going up, but sales went way down. Which means people are getting priced out of the market. You look at that right here in Birmingham. We do a Birmingham area market analysis every single month. Same thing's going on right here in Birmingham. Average sales price is going up, total sales going down. Inventory's down. Inventory's been down this whole time, but total sales are starting to go down. This is the first time we've seen many consecutive months where total sales are going down. So what does all this mean? It means you got to be paying it. For me, it means we're coming to the end of the cycle. That doesn't, I'm not a fortune teller. It doesn't mean it's going to happen in the next 3 months or 6 months. Real estate's one of those assets to where you're never, even in 2006 and 7, you saw it coming. If you look back now, you could totally see it coming. Like literally a year, you could see it coming. Wall Street's not like that. You can't see it coming. It can just drop off the map in a heartbeat. And plus you're not tied to a hard asset. That's why I don't really like stocks. I love real estate because you can see it coming a mile away, and you've got to start paying attention to the trends and what's happening in your local area, wherever you're investing. And especially if you're in California, you're in Florida, you're in Arizona, you're in Nevada, you're in these places, and you can see things are already flat. They're starting to flatten out.
Okay, so somebody listening, they've got their powder stored up right now. Their policy, they've been saving in their policy for years and years. They're sitting on 100,000, 200,000, and they're like, Joey, what can I be doing with this thing?
You want me to give
and
you
then
the
all of a
answer?
sudden they say, Brian just totally poo-pooed
That's right.
this idea of cash flow turnkey real estate. What do you tell them?
Lend.
Okay.
You have to lend today.
All right. Explain.
You've got to stop buying turnkey real estate today, not forevermore. I'm not saying, the way you kind of phrased it is turnkey real estate is bad, never do it. I definitely don't agree with that. So make sure that we're understanding the context of the conversation. We're recording this in October, November of 2018. So make sure we got context here. Today is not a good time to buy turnkey real estate because you're buying at the very top of the market.
So when you say be a lender,
Yes.
is that so that you can be an owner of the real estate whenever?
No, you're not. You're not an owner. If you're a lender, you're not an owner.
Well, but you're an owner without owning the deed in the event that they default on you, right? Now you own the real estate.
So you would be a mortgage or a lien holder, just like if you have a mortgage on your personal home. A lot of people get this confused. If you have a mortgage on your house, I usually ask the question at some of my training events. I ask, who owns the property? If you have a mortgage on your house, who owns the property? Does the bank own it or do you own it?
You own it.
You own it.
Right.
Most people think the bank owns it.
Right.
And that's totally not true. Same scenario is going on here. If you're a lender, you are a lien holder, just like you're the bank. And we go back to Rich Dad, Poor Dad. What does that teach us? Be the bank, not the banker.
Right.
And that's true probably across the board. If you can get to the point to where you are the bank, and if you have some of these contracts, some of these policies that these guys do here, you are positioned and you're set up perfectly to be a lender. You want me to talk about lending and why it's so great?
Yeah, well, I want to talk
how to
about
structure
lending.
that. Yeah,
Well, I mean, first thing that comes to mind is I'm going to lend against these same properties that you think are overvalued,
Yep.
and so these guys are going to have trouble.
Okay,
Right?
so you want me to tell you why they won't?
Exactly. Yeah, I want to hear this.
This is huge. This is enormous. So let's just take me, for instance. I'm a real estate investor. I hardly ever buy with my own money. Okay? OPM, right?
Right.
Other people's money. I hardly ever buy with my own money unless I'm investing my money, unless I'm, long-term investment. I'm going to put my money in play. Short-term stuff, like a fix and flip, like a rehab project, I never use my own money. For certain things, we do some creative stuff, like we call it wholesaling, where sometimes we have to actually purchase the property. We actually buy the property and then turn right around and sell the property. We need some gap funding. Sometimes we need it for a month. Sometimes we need it for 2 months. You asked the question, well, how's my money safe? You just got done telling me if real estate takes a dive and it takes a 20 or 30% dive, which, by the way, that's rare. The crash that we had in 07, 08, I'm not a fortune teller, but it's going to be, I've heard a lot of people say this. Most people agree that we're never going to see something like that ever again, where you're going to see 30% drop-offs. But we could see a 10% correction, right? We could see 15, maybe even 20 in a bad market. We see a 20% correction. So how do I stay safe if I'm the lender?
Right.
Awesome question. Guess what? If you're lending to someone like me, and this isn't a commercial for you to lend to me, by the way. I'm not saying, but if you're
Put my checkbook
someone
back
like
up.
me,
Hold on. Okay.
someone like me, any real estate investor who is rehabbing property, I'm never going to buy the property at more than 70% loan to value, ever. If I do, I can't make money. So I'm never going to buy the property at more than 70% of what it's actually worth. Therefore, if it does take a 10% correction, which, by the way, we're going to see that coming, that's not going to happen overnight. We're going to see that coming. That's going to happen over the course of 6, 8, 10, 12 months. So your money is safe because it's backed by a hard asset and because I'm never going to buy it more than 70% of what it's worth.
Right. In that scenario, you just need to make sure the person, and we talk about this all the time, is where you put your money, you need to either control the return of it, meaning you're actually doing something, or you need to be investing in a person who can. So if I'm investing in you, I can go look at your history, I can look at your background, and I can figure out, okay, this property you're talking about, what is the comp on it, and how much are you paying for it? So then I can do that. But I think there's some people out there that, and by the way, we've seen this too, where unfortunately some people lie. And they say they're lending money against 100%, and they're or against 60%, and they're lending against 110%.
So let's just talk about private lending here, just in general, just generalities. It's of my opinion that you should not lend to someone haphazardly, someone that you don't know. Typically, lending is a relationship business.
Absolutely.
That's why I just got done. That's why I said this isn't a commercial for you to lend to me. Whoever's listening to this, obviously we are looking for funding, but I want to build that relationship with you first. You've got to get to know the person you're lending to. You need to see HUD statements. You need to see HUD 1 statements, closing settlement statements, making sure that people are who they say they are.
Right.
You need to get a BPO, a broker's price opinion. So anytime you're lending on a property, make sure that you have an independent BPO on that property where a broker can give you the opinion of what they think that property is going to be able to sell for. They'll give you an as-is value, and they'll give you their opinion of what it could sell for. So make sure you're doing these things. Make sure you have insurance. You're the additional insured on the project. So if the worst were to happen, say the thing burns down, because your money is tied to a hard asset. You want to make sure that you're protected there. There are all these safeguards in place. This is why I love real estate, guys. Real estate is the safest. It's the safest investment that you can make. It just is. You're tied to a hard asset, and I am never buying it more than 70% of what something's worth.
So this is critical. I mean, you have totally shifted the game on us. We came in here saying, okay, we're going to cover this pillar of Wealth Without Wall Street today, real estate. And then you shifted to lending. But the cool thing is you're pointing out something we've been saying for years is these are both primary things of somebody's portfolio. Something they should be diversified in is lending and real estate, or lending against real estate in this case.
Let me qualify this for a second. You have to pay attention to the market cycle. You have to understand where you are. We're talking about lending today. In 3 or 4 years, we probably won't be talking about lending. And we have to understand the context of this conversation. I'm specifically talking to someone who wants to be a quote unquote passive investor. I'm not talking to someone who wants to get in the real estate business and be a real estate professional and do it on their own. Look, there are tons of opportunities to get out there and buy real estate at discounts for value add plays, where you can buy it where, just like I do.
Right.
I buy it at a discount, put some money into it, put some work into it, make it look better, get a tenant in there, and then we resell it. How do you think, companies like Spartan Invest, how do you think they operate? How do they make money? It's value add.
Right.
They go and buy something from somebody like me. They go and buy something at a low price that they can fix up, put a tenant in, and they can resell it for market value. That's their business. There's nothing wrong with that business. It's a great business. But you have to understand, as an investor, where's the market? What market cycle are we in? We're in a market cycle to where if you do have cash, or you have a policy that has a lot of cash in it, how can you get the best bang for your buck the safest? Right? We all want that.
Right.
The safest way to get the best return on my money. Well, guess what? There are a lot of times right now you can get 10%, you can get double-digit returns on your money right now, somewhat passively, with not doing a whole lot of work, and you don't need a ton of experience.
Well, I don't want to get into all the nitty-gritty details, but you saying 10%. I mean, are there anything else that you need to, like, somebody listening to this says, hey, I'm interested in this. What other things should they be asking about a lending relationship? Like, what other kind of terms do you see normally kind of set aside for that kind of thing?
So I can't really talk to terms because it's all negotiable. So there's two. Let's talk about lending. I didn't know this was going to be a show on lending, but I'm totally glad that it is, because I think that this is where we're going to provide the most value, I think, to your audience. So there's two different types of lending going on. There's private money lenders, and then there are what people call hard money lenders, which it really doesn't even make any sense. They call it hard money because it's tied to a hard asset, but so is private money lending. But a lot of people think hard money lending is just it's more expensive money.
It's harder. The asset's harder.
It's not. It's the same. It's the same asset. They're both tied to hard assets. But some people confuse that. But we'll just use that terminology: hard money lending versus private money lending. If you are listening to this show and you think, Brian, maybe you've convinced me a little bit. Maybe I need to at least look into this, get a little bit more educated on what I should do with lending. There are two different camps you can get into. You can be completely passive and literally put money into a fund of people who already are managing that fund, and they go out and do the hard work of finding people like me. They vet the people, they vet the property, and you're probably going to get pretty low returns there, probably somewhere in the 3 to 6% range.
Okay.
If you want to get with somebody that's like direct, I think that's any business whatsoever. If you're working direct with the person, you're going to get a better return on your money.
How close you are to the investment.
Right, exactly. So if you're
Talk
going to
about
work
that.
with someone like me, or you already have relationships, I think your question was, how do we vet these people, or how do we get into a relationship with these type of people?
Yeah.
Go to networking events. Go to, we host networking events here locally in Birmingham. There are networking events, all over the place. I would highly suggest that you don't go in there and just say, hey, I'm looking to lend money. I highly suggest you don't do that.
Have like some $100 bills hanging out of your breast pocket.
Don't
there.
do that. It's going to be a big mistake. Just trust me.
Okay.
But it's relationship based. And so you've got to start building relationships with people that you trust. If you've gotten to know these guys here, definitely get in touch with them, that they're going to be able to help you with maybe direct you in the right place.
Well, and that goes back to it all. It always has. I mean, you started off the podcast talking about instruction and getting, not that education is bad, but you need to know kind of what to do. And we do the same thing. There's really no passive income.
No system.
I mean, that is dumb money. We substitute passive for dumb a lot of times. What people want is that they want their money working for them.
Totally.
But there's work that has to be done, because you can, I told Joey the other day, we're talking about my high school GPA, and I was like, I can prove to you can never put in minimum results or minimum effort to get maximum results. And that's what we see out there, is what you're talking about, is going to these networking functions, going to these real estate functions, not only learning what people are doing, but building relationships, and then finding opportunities to get your money at work with somebody that, now that you have understanding, does this person have the ability to return my dollars with interest to me? And you can probably figure out really quickly who the real players in the game are,
Totally.
and who's not, by just being there. That takes a little bit of work. That's a little bit of effort that some people are not willing to go through. We are totally not the money babysitter crowd here.
Yeah. And I love what you also said very practically. You have to inspect what you expect. Someone can tell you, yeah, this is backed by real estate, but if there was never a mortgage drawn up and attached to that property, guess what? There ain't an asset attached to your money. If you have no insurance, if you're not named as a
Additionally,
The loss payee,
the loss payee, then you're not protected from that. So it doesn't matter how well you know the person, there has to be documentation to back this kind of thing up. So that's very practical. And, I'm sure people are, getting a lot of value out of that. So, okay, again, you shifted the tables on us. We went from real estate to lending, but it's all connected, these pillars. What else can somebody do to continue this learning? Like, what are some other resources that you highly recommend people look to?
As far as lending goes,
Yeah.
or is just as far as real estate in general goes?
Lending. Let's go lending. We've shifted.
So I've given you a lot of kind of theory today. I've given you some practical stuff. We've all kind of given you some practical stuff, a couple of things. But at the end of the day, it's really a relationship business. So there's really not a whole lot of learning to do. You want to learn more. I think we've pretty much covered the basics. You can go through. Just Google search. If I'm a private lender, Google is everybody's friend. If I'm a private lender, what documents do I need? Things like that. If you work with someone who's a little bit more advanced, that has been doing this for a while, they're going to have all the documents set up with their attorney anyway. Like for me, I never touch the money. And I think that's one thing that you should be looking out for if you want to get into lending. The money actually never comes to me. The money comes to an attorney's office, comes to their escrow account. I never see the money. The money goes straight into purchasing the real estate, and you get your settlement statement right there. You get your insurance packet. You get the mortgage, the note, all the paperwork associated with being a lender is right there. So just do one. Start small. Take action. So I think that anyone who gets started with anything, the big hurdle, the big challenge is actually like going and taking that first step and actually taking action. Well, take action. Lend on like a $50,000 property. You might be saying, Brian, I don't want to lend on a $50,000 property. That's probably in a war zone somewhere. And well, here's the thing about Birmingham and a lot of cash flow markets, by the way, Memphis, Charlotte. You mentioned Kansas City, Indianapolis. There are even parts of Dallas, Houston. There are markets. These are cash flowing markets that I've named. These are cash flowing places where you can go get like right now, we're buying a piece of real estate for 30, 40,000, put 20 into it, and we're selling it for 80,000. That's a typical deal here in Birmingham. It's a very typical deal, and it's in a B-class neighborhood. Pretty solid neighborhood here for Birmingham. So start slow. Lend 30, 40,000, 50,000, and let's just start there.
Yeah, the more you understand how that is, then you can start to upgrade your investments to be able to go bigger. So, all right, I'm doing this for the next couple of years. I'm watching the market, right? I'm in a position with my cash that I'm earning decent returns on it. I'm putting it at work. The market starts turning. I see that. What is it that I'm looking for the market to turn for me to move from lending back into more cash flow and property?
You want it to hit the bottom. You're not going to get back to buying real estate until it's bottomed out or until you start to see that it's. So if we just use our previous market cycle, let's just use 2006 through 2009 as an example. 2006 and 2007, if you're a savvy guy, which there are a lot of them out there, they were paying attention to the cycle, you were getting out. I know a couple of guys this past weekend we met that were talking about, I literally sat on cash. And most people tell you that's the dumbest thing to do because the rate of inflation is making your cash worth less. I was literally sat on cash for 2 years. From 2007 to 2009, I sat on cash. And if people have policies like you guys have, they're at least still earning something. Right? So that's something I would advise. Wait till it bottoms out. You're gonna lend even when it starts to go down. It's still okay that you lend because you're still lending at, again, things aren't going to fall off a cliff. It's going to be gradual. You're still going to lend, and people still do business. They still flip houses. They still do it successfully. So you just have to be more cautious. Maybe you lend at 60% LTV, loan to value, instead of 70%. You see what I'm saying?
Yeah.
So let's talk about the next market cycle. When it hits the bottom and you see things are actually starting to come back up, 2009, 2010, 2011, maybe you want to wait a year or two. This is where all the carnage is out there. Everybody's taking a beating. This is where you're going to go buy properties for 30, 40, 50 cents on the dollar. And this is where you put all that liquid money that you had because you were lending. You were doing all these short-term loans, these 3 to 6 month loans. You're liquid. You've stayed liquid this whole time. This is when you go out and you buy. This is where people make a fortune. And it's go and look throughout time. Throughout our history, our country's history, people have made a fortune in the stock market and in real estate by getting in when we're coming out of a recession.
Yeah, you got to find, you need to be buying when everybody else is selling and selling when everybody else is buying. And that's why, we're sitting here right now today where the stock market is down 9% for the month of October. And there's still people out there shoving money into it and they're missing the boat. But, well, tell me just real quickly, what do you see success looking like for somebody who is actively following these patterns and how that's different? Because you've seen it. You've been in the real world and coaching and stuff like that. I know the other coaches probably were talking about their retirement plans and everything, and you've been in real estate now for 6-7 years, and you're starting to see what success looks like in this. Help the person who's listening that maybe is just now getting their toe wet into this world. What success will look like for them just based upon some of the things you're experiencing, others that you've been around?
Yeah, so success is obviously defined in a lot of different ways by a lot of different people. But for me, it's you have to understand your market cycles. You have to obviously educate yourself for sure. But being successful is especially when it comes to real estate, is being conservative with your money. And you've got to be conservative. Real estate is so safe and you can make tons and tons of money by being conservative. So be conservative. Slow. You ask what's success to me? Slow and steady wins the race. You're not going to sit here and if you want to try to plow a ton of money into real estate today, you're probably going to be a big loser here in the next 5 years.
Yeah.
So don't try to become an overnight success. Let it happen slowly.
Now, we don't have a ton of time, but I want to mention something that we may need to expound on another episode. But the really cool thing about what you said about using policies in this case, being conservative about these lending opportunities potentially. One of the things we probably haven't hit on too much, when we borrow from a policy.
From a life insurance policy.
That's, again, we're stocking full of cash. We're borrowing at 4 to 5%, right? And let's just use 5% for instance. And then we lend it out at 10%. You mentioned earlier, you want to be the bank, not the banker. In that scenario, that person is not just making a 10% or a 5% difference in the cost of money versus what they're earning. It's actually 100% return on those dollars. Now, you want to talk about being conservative but being smart? That's being the bank. That is getting 100% on what other people, if they use their cash, is only a 10% return. How many times can we do that? You don't have to work as hard if you're working that smart. So again, we probably don't have time to go into more detail. I just want to mention that as we wrap up. And Brian, I can't thank you enough for being here. This has been awesome. Again, you kind of flip-flopped on us here, but I'm grateful. I do want to point people to your book. I think it's a great read. It's about adding value before you ever sell a thing. The title, Nothing's for Sale. Tell me, where can they find that? And then if there's any other resources you want to add, and then we'll wrap up.
Yeah, thank you for the opportunity, Joey. I usually actually give that book away, and we've just run out of free copies. So I apologize. The only way to get it today is on Amazon. And so you can just look up my name, Brian Trippe, or you can look up Nothing's for Sale. It's the only things that pop up when you get into Amazon. It is there. And then just if you want to get in touch with me, just for whatever reason, I'll just give my personal email address. It's not a big deal. It's just my name at gmail.com, Brian Trippe at gmail.com. The last name has 2 P's and an E. So TRIPPE. And I'm sure y'all link it all up in the show notes. So.
Yeah. Well, I'll tell you, especially for anybody who's watching with us live now on Facebook, if you will go on and give us a review, take a picture of that and send it in to info@wealthwithoutwallstreet.com, we'll buy 5 copies of your book and we will give it to them for free.
Bam, there you go.
There you go.
How about that? So go give us a review, take a screenshot of that review, send it to info@wealthwithoutwallstreet, and we'll give you the book that shows you how to become the local real estate authority by giving everything away.
There you go. And guys, again, I appreciate the opportunity to come in here. I know I kind of flip-flop the topics. I've been doing this for a while. Marketing is really my bread and butter. I love marketing, but I think for you guys and for your audience, hopefully they got a lot of value out of what to do with your money if you're in real estate. And so I really do appreciate the opportunity, guys, for having me on the show.
Absolutely.
I love what you guys do, and I'm a big fan. So
likewise,
keep doing it.
Thank you for coming in.
This has been the Wealth Without Wall Street podcast. Don't forget to subscribe to the show to break free of the Wall Street mindset and begin building wealth on your own terms in places you understand so that your wealth will never run dry. See you next episode.